I mean, this whole idea of the dollar losing its status as the world's reserve currency, I think we both agree that, look, it may not happen, who knows, but that's a long way off. And it's maybe a little bit too early to start talking about the dollar's demise as the world's reserve currency. This whole trend of de-dollarization, that is real, that is happening, that has been happening. What we've seen so far this year, especially the last month or so with the situation in the Middle East, has that just exacerbated the situation? Because we noticed the dollar did briefly pick up a bid, a safe haven bid, but it didn't last for long.
Yeah, well, I mean, first of all, I want to strongly emphasize, I agree with the point you made that losing the reserve status, losing the status as the currency that's most used more than any other in all sorts of international commerce, trade, finance, borrowing, lending, hedging, investing, and so forth. The dollar is so entrenched, and the alternatives have so many drawbacks that I just don't see that happening anytime in the foreseeable future, whatever foreseeable means. But having said that, yeah, it's certainly conceivable to me that because of I think the main factors would be this bashing of the Fed and undermining its independence, combined with the prospects for massive deficits as a result of the budget bill. It's the big ugly bill, as I would prefer to call it, but that's a matter of opinion. Having just passed the Senate, that the prospects for the Treasury having to issue even more bonds to borrow than it has in recent years. I mean, that makes people inclined to unload those things and drive up interest rates. That could be quite bad for the U.S. economy.
Yeah, and Paul, you've been sifting through. I haven't actually seen it. The BIS, Bank of International Settlements, and they're meeting up in Sintra as we speak. Right? They did some interesting work about what happened in April in markets. There was a bit of a ride. We had everything falling at the same time: stocks, bonds, even the dollar. And apparently, a lot of the pressure on the dollar was technically driven.
Yeah, I mean the BIS. I mean, for my money, they do the best, really the best work. And there's a lot of people analyzing why things happen in markets. They've got tremendous resources and data to draw on. And what they found was that is the almost certain explanation for what happened in Asia when you had this rather perplexing, combination of falling dollar, falling stocks, falling bond prices. Usually you don't have those things all together. But what happened was that a lot of big investors, especially in Asia, who were heavily invested in dollars assets, in treasuries, and other dollar assets. But they had not hedged themselves completely because it's expensive to do that. And when they saw the dollar start to fall at the beginning of Asia, they rushed to put on hedges, which means they had to sell dollars in the spot market. I know this gets a little bit technical, but I mean so there tended to be this feedback effect that drove the dollar further down. But that wasn't because they were unloading, dollar assets. That was because they were hedging themselves. They had not. They do tend to hedge themselves pretty heavily, but it gets expensive, and the more expensive it gets, the less. They think, well, we're making a pretty good return on our dollar in investments, and so let's take the risk of not hedging. But then when they saw the dollar start to fall, they rushed to put on hedges, so that was all. And the BIS found that almost all of a very high proportion of the pressure on the dollar during that period came in Asian market during Asian trading hours. So this would have been Japanese insurance companies, Taiwanese insurance companies, and big holders of large pools of money, heavily invested in the dollar but hadn't hedged themselves completely. So that's almost certainly the best explanation for what happened.